You are in Italy. Imagine you got in a time machine in 2007. You traveled 18 years into the future to December 2025. You step out expecting flying cars and a richer Italy. Instead, you're 5% poorer than when you left. You didn't travel forward. You traveled backward. Welcome to the Italian nightmare. Meanwhile, the rest of Europe? They're 15% richer than they were in 2007. Germany, France, Spain, even Portugal, all of them moved forward. Italy moved backwards. Think about what that means. If you were a young Italian starting your career in 2007, you've worked for 18 years and you're worse off than when you started. Your parents' generation was wealthier than you are. Your children will probably be poorer than you. This isn't a recession. This isn't a temporary crisis. This is permanent decline. In the third quarter of 2025, Italy's economy grew 0%. Not slow growth. Zero. Completely flat. While the Eurozone grew 0.3%, Italy stood still. Italy used to be one of Europe's success stories. The fourth largest economy in the EU. Home to fashion, supercars, world-class manufacturing. Now, it's Europe's sick man. Drowning in debt, bleeding talent, and trapped in a system it can't escape. Today, we're going to explain exactly what went wrong and why Italy can't fix it. Let us start with the number that should horrify every Italian. GDP per capita in 2025 is 5% below where it was in 2007. Not 5% growth, 5% decline. Your average Italian earned more money, adjusted for inflation, in 2007 than they do today. That's almost 2 decades of economic reverse. Compare that to the Eurozone average. The rest of Europe's GDP per capita grew 15% since 2007. Not 5%, 15%. They're 20 percentage points ahead of Italy. 20 percentage points. That's not a gap. That's a chasm. That's the difference between a functioning economy and a failing one. In 2025, Italy's economy grew 0.5% for the full year. Sounds slow but positive, right? Except the Eurozone grew 1.3%. Italy is growing at 38% of the speed of its neighbors. The third quarter of 2025 was even worse. Italy's growth? 0%. Completely flat. The Eurozone? 0.3%. Not impressive, but at least moving forward. Italy isn't just slow. It's stuck. And the gap between Italy and the rest of Europe widens every single quarter. But how did this happen? Here's the core problem that nobody wants to talk about. Italy stopped getting better at making things. Economists call this productivity. It means how much value workers create per hour of work. Since the year 2000, Italy's productivity growth has lagged behind the Eurozone by 0.5% every single year. 0.5% doesn't sound like much, right? Wrong. Over 25 years, that compounds into catastrophic underperformance. If you fall behind by 0.5% every year for 25 years, you end up roughly 12 to 13% behind where you should be. That's exactly what happened. Italian workers today produce about the same amount per hour as they did 20 years ago. Meanwhile, German workers are 15% more productive. French workers are 12% more productive. Even Spanish workers are more productive. Why does productivity matter? Because productivity determines wages. If you're not producing more value, companies can't pay you more money. Wages stagnate. Living standards stagnate. The economy stagnates. Italy's productivity has been flatlining since 2000. And that's why Italy has been falling behind for 25 years straight. But why did productivity collapse? The reason Italy's productivity collapsed is simple. They stopped investing in the future. Specifically, they stopped investing in what economists call intangible assets. That's things like research and development, software, patents, employee training, and innovation. Here's the devastating number. Italy invests 8.4% of GDP in intangible assets. France invests 16%. Italy invests half of what France does in innovation and technology. Half. Let that sink in. Your competitor is spending twice as much improving their business, and you're wondering why you're losing. When you don't invest in R&D, you don't develop new products. When you don't invest in software, your processes stay outdated. When you don't train workers, they can't adopt new technologies. You just keep making the same things the same way, year after year after year. And while you're standing still, everyone else is moving forward. Germany invests heavily in advanced manufacturing. France invests in aerospace and pharmaceuticals. Even Spain increased innovation spending after their crisis. Italy. They make beautiful leather handbags and sell Ferraris to rich people. Both great products. Both unable to support an economy of 59 million people in the 21st century. You can't innovate your way forward if you refuse to spend money on innovation. Now let's talk about the weight dragging Italy underwater: debt. Public debt at 135.3% of GDP. That means Italy's government owes more than the entire country produces in a year. To put that in perspective, the European Union average is around 83%. Italy's debt is 52 percentage points higher than the EU average. Only Greece has worse debt in the Eurozone. Here's why this matters. When you're drowning in debt, you can't invest. Every euro the government collects in taxes has to go toward paying interest on old debt. There's nothing left for building infrastructure, funding research universities, or subsidizing new industries. Italy spends billions every year just servicing debt, not paying it down, just paying interest to keep the creditors happy. Money that could have built high-speed rail, funded startups, or retrained workers instead goes to bondholders. And it's getting worse. Italy's debt reversed its post-pandemic decline. It was falling for a couple years after COVID, but now it's rising again. Because Italy can't grow fast enough to outpace the debt. This creates a vicious cycle. High debt prevents investment. Low investment prevents growth. Low growth increases debt relative to GDP. Repeat forever. Italy is trapped in a debt prison with no key. Italy has another problem. The jobs its economy creates are the wrong jobs. Over the past 20 years, Italian workers have been shifting from manufacturing and skilled trades into low-skill service sector jobs. Tourism, hospitality, retail, personal services. These are fine jobs, but they're low-productivity jobs. A barista or a hotel clerk creates less economic value per hour than an engineer or a factory worker using advanced machinery. This shift matters because productivity determines wages. Service jobs pay less because they produce less value. So as Italy's workforce moves into services, average wages stagnate. Compare this to Germany, which kept its high-productivity manufacturing base, or France, which developed high-tech services like software and finance. Both countries created jobs that pay well because they produce a lot of value. Italy's labor market is also rigid. It's hard to hire and fire workers. That sounds good for workers, but it makes companies afraid to hire in the first place. So youth unemployment stays high, and businesses can't adapt quickly to changing markets. The result? A workforce stuck in low-paying jobs with no dynamism, no growth, and no hope of improvement. And that workforce is getting older. Italy used to be an export powerhouse. Fashion, furniture, machinery, cars, made in Italy, meant quality and style. But Italy's exports are dying, and 2025 proved it. Net exports subtracted 0.6 percentage points from Italy's GDP growth in 2025. That means Italy imported more than it exported, dragging the economy down. In trade terms, Italy is bleeding. Part of this is the trade war. U.S. tariffs in 2025 subtracted 0.2% directly from Italian GDP. American buyers are taxed heavily on Italian goods, so they buy less. Italian exporters suffer. But the bigger problem is competitiveness. Italy can't compete on price with China. It can't compete on innovation with Germany. And it can't devalue its currency to make exports cheaper because it's stuck in the euro. So Italian exports slowly lose market share. Luxury goods still sell, but mass-market products get destroyed by cheaper alternatives. And since Italy can't print money or lower its own interest rates, there's no policy tool to help exporters. Italy is fighting the global economy with one hand tied behind its back. And it's losing. Here's the trap that makes everything worse. Italy uses the euro. That might sound like a benefit: stable currency, easy trade with Europe, no exchange rate risk. But it's actually a prison. When a country has its own currency, it has options. Japan faced a crisis. They printed yen and bought their own debt. The UK faced problems. They devalued the pound to boost exports. America has issues. The Federal Reserve cuts interest rates. Italy can't do any of that. The European Central Bank sets interest rates for the entire Eurozone. If Germany needs high rates and Italy needs low rates, tough luck. The ECB picks a middle rate that satisfies nobody. Italy can't print euros. Only the ECB can do that. So Italy can't monetize its debt the way Japan or the US does. Italy can't devalue its currency to make exports competitive. The euro's value is set by the entire Eurozone's economy, not just Italy's needs. This is the fundamental problem. Italy has all the economic weaknesses of a struggling country, but none of the policy tools that countries normally use to recover. It's like being sick but not being allowed to take medicine. You just suffer and hope it gets better on its own. It doesn't get better. Let's compare Italy to Spain, because this comparison destroys every excuse Italian politicians make. In 2008, Italy and Spain were in similar positions. Both had housing bubbles. Both had high unemployment. Both were in crisis. Both were stuck in the euro with no monetary policy control. Spain's unemployment hit 27%. It was catastrophic. But Spain did something Italy refused to do. They reformed. Spain reformed labor markets, making it easier to hire and fire. They cut bureaucracy. They attracted foreign investment. They restructured banks. It was painful. People protested. But they did it. The result? Spain's economy started growing again. Today, Spain often grows faster than the Eurozone average. They're recovering. Italy refused to reform. Labor laws stayed rigid. Bureaucracy stayed crushing. Foreign investors stayed away. Banks stayed weak. And the economy stayed stagnant. Both countries started from the same place in 2008. Spain is now growing. Italy is shrinking. The difference wasn't luck. The difference wasn't the euro. The difference was political will. Spain had leaders willing to make painful choices. Italy had leaders who kicked the can down the road. And now Italy is paying the price for 17 years of cowardice. Now let's compare Italy to France, because this comparison shows what Italy could have done differently. France has high public debt, just like Italy. France is around 113% debt to GDP. Italy is 135%. Both are way too high. Both countries are in the euro with limited policy tools. But France grows faster. Why? Investment. France invests 16% of GDP in intangible assets, research, innovation, technology. Italy invests 8.4%. France spends twice as much on the future as Italy does. France has world-class aerospace companies like Airbus, pharmaceutical giants, tech startups, nuclear power plants that export electricity. Italy has fashion and tourism, both wonderful industries, both insufficient. The lesson is simple. Even with high debt and Eurozone constraints, you can grow if you invest in innovation. France proves it. Germany proved it for decades. Even small countries like the Netherlands prove it. Italy chose not to invest. And now Italy is falling further behind every year. Debt isn't destiny. Investment is destiny. And Italy stopped investing 25 years ago. Italy has another problem that makes recovery impossible. Nobody's spending money. Private consumption in 2025 is only 0.8% above 2019 levels. That's 6 years of essentially zero growth in consumer spending. Why aren't Italians buying things? Because they don't have money. Real wages, what your paycheck can actually buy after accounting for inflation, are barely higher than they were before COVID. You can't have economic growth if consumers aren't spending. Consumer spending is 60% of GDP in most developed countries. If that's flat, your economy is flat. Compare this to other European countries. German consumers are spending. French consumers are spending. Even Spanish consumers recovered their purchasing power. Italian consumers? Broke. Worried. Saving instead of spending because they don't trust the future. And they're right not to trust it. Wages aren't going up because productivity isn't going up. Productivity isn't going up because investment is too low. Investment is too low because debt is too high. It's a doom loop. When your population stops believing in a better future, they stop spending. When they stop spending, the economy dies. Italy's economy is dying because hope is dying. Now let's talk about Italy's future, or rather, the lack of one. Young, educated Italians are leaving the country in massive numbers. If you're a 25-year-old Italian with a university degree, why would you stay? Unemployment is higher than the rest of Europe. Wages are lower. Career opportunities are scarce. Innovation is non-existent. So you leave. You go to Germany, where manufacturing jobs pay well. You go to the UK or Ireland, where tech jobs are plentiful. You go to the US, where startups hire aggressively. This is called brain drain. The smartest, most educated, most ambitious people flee the country. And when they leave, they take their skills, their energy, and their future tax contributions with them. Who stays? The old, the unskilled, and those who can't afford to leave. This accelerates decline. Fewer young workers means lower growth. Fewer entrepreneurs means less innovation. More retirees relative to workers means higher social spending. Italy is losing a generation. The people who could have saved the economy are living in Berlin, London, and San Francisco. They're solving other countries' problems while Italy stagnates. You can't build a future without young people. And Italy's young people are leaving. Italy has one of the most bureaucratic economies in Europe. If you want to start a business, it takes months of paperwork, dozens of permits, and endless fees. Want to hire an employee? Prepare for crushing regulations and payroll taxes. Want to fire an underperforming worker? Good luck. The labor laws make it nearly impossible. Want to build a factory? You'll need environmental permits, construction permits, zoning approval, and probably bribes to speed up the process. This bureaucracy acts like a tax. It doesn't show up on the budget, but it destroys economic activity just as effectively as a 50% tax rate would. Foreign investors look at Italy and run away. Why invest in a country where it takes 2 years to get a permit when you can invest in Poland or Ireland and start operating in 6 months? Domestic entrepreneurs give up. Why fight the bureaucracy when you can just work for someone else or move abroad? The result is an economy with almost no new businesses, no foreign investment, and no dynamism. Everything moves slowly. Everything is difficult. And slow, difficult economies don't grow. Italy has had 70 governments since World War II ended in 1945. That's roughly one government per year. Political instability is baked into the Italian system. Why does this matter? Because long-term reforms require long-term governments. If you know your government will collapse in 18 months, why would you implement painful reforms that take 5 to 10 years to work? You wouldn't. So Italian politicians focus on short-term handouts and kick every hard decision down the road. Labor reform? Next government will handle it. Pension reform? Too politically toxic. Let's wait. Bureaucracy reduction? We'll form a committee to study it. Meanwhile, Spain reformed. France reformed. Germany reformed decades ago. All of those countries had political will to make hard choices. Italy? Every government is a coalition of 5 different parties who disagree on everything. Every reform gets watered down until it's meaningless. Every tough decision gets delayed until it becomes a crisis. This political paralysis is why Italy has been stuck for 25 years. It's not that Italians don't know what needs to be done. They know. They just can't muster the political will to do it. And without political change, economic change is impossible. So what's the future look like? Let's check the official forecast for 2026. Italy's economy is projected to grow 0.8% in 2026. The Eurozone? Projected to grow 1.2%. Even in the optimistic scenario, Italy continues falling further behind. The gap doesn't close. It widens. And these forecasts are usually too optimistic. Governments always project better growth than actually happens because admitting the truth is politically toxic. So realistically, Italy might grow 0.5% in 2026. Maybe 0.3%. Maybe 0 again. Meanwhile, the Eurozone will grow 1 to 1.5%. Germany will recover from its current slump. France will keep chugging along. Spain will keep outperforming. And Italy? Still stuck. Still stagnant. Still falling further behind. By 2030, Italy's GDP per capita might be 10% below 2007 levels, while the rest of Europe is 20% above. The gap will be 30 percentage points. At that point, Italy won't just be the sick man of Europe. It'll be the dead man of Europe. A museum economy. Beautiful to visit. Terrible to live in. Some Italians ask, should we leave the euro? Would that fix things? It's tempting. If Italy had the lira again, they could devalue the currency to boost exports. They could print money to fund spending. They could set their own interest rates. But leaving the euro would be catastrophic. Here's why. First, all of Italy's 135% debt is denominated in euros. If Italy left and created a new lira, that lira would immediately collapse in value. But the debt would still be in euros. So Italy's debt burden would double or triple overnight in lira terms. Second, every Italian's savings is in euros. The day Italy announces it's leaving, there would be a bank run. Everyone would try to move their euros to German banks. Italy's banking system would collapse instantly. Third, Italy imports oil, gas, and most raw materials in euros or dollars. A collapsing lira would make all imports catastrophically expensive. Inflation would explode. Fourth, international investors would panic and demand huge interest rates to lend to Italy. Borrowing costs would skyrocket. Leaving the euro would be economic suicide. Italy is trapped. They can't stay and thrive. They can't leave without disaster. There is no escape hatch. Italy isn't alone in stagnation. Look around southern Europe. Portugal, Greece, parts of Spain, they all share similar problems. High debt, low productivity, Eurozone trap. But Italy is the warning for everyone. Because Italy is the third largest economy in the Eurozone. If Italy fails, it takes everyone down. Greece collapsed in 2010 and needed bailouts. But Greece is small. The Eurozone could absorb it. Italy is too big to bail out and too big to fail. If Italy's debt becomes unsustainable, there's no rescue package big enough. The entire Eurozone banking system would be at risk. Germany and France would face their own crisis. This is the nightmare scenario that keeps European leaders awake at night. They can't let Italy collapse, but they can't force Italy to reform. So they just hope. Hope that somehow Italy figures it out. Hope that somehow growth returns. Hope that the problem solves itself. It won't solve itself. Stagnation doesn't magically reverse. Italy has been stagnant for 25 years. Without radical change, it'll be stagnant for another 25. And eventually, hope runs out. So here's the brutal truth. Italy fell behind Europe because it stopped investing, refused to reform, drowned in debt, and got trapped in a currency system it can't escape. Italy's GDP per capita is 5% below 2007 levels. The Eurozone is 15% above. That's a 20-point gap that widens every year. Italy grows at 0.5% while Europe grows at 1.3%. Quarter after quarter, year after year, the gap grows. Italy invests half of what France invests in innovation. Italy's exports are bleeding market share. Italy's young people are fleeing. Italy's political system is paralyzed. And there's no fix. Leaving the euro would cause disaster. Staying in the euro means permanent stagnation. Borrowing more increases debt. Cutting spending destroys growth. Italy is trapped in a slow death spiral. Not a dramatic collapse. Just a gentle, relentless decline into irrelevance. 18 years ago, Italians were 5% richer. 18 years from now, they'll be 10% poorer. The country that gave the world the Renaissance is becoming a museum. If this video helped you understand why Italy is struggling to compete, smash that subscribe button. We cut through the noise and break down the economics. No political spin, no slogans. Now I want to hear from you. Is Italy already past the point of no return, or is there still a way out? I read every single comment. Take care of yourself. Bye.